Hello and welcome to Bookmint, the channel where we distill the most powerful ideas from the world's best books to help you live a richer, freer life. I'm your host, and today we're diving into a book that has become a cornerstone of the financial independence movement. J.L. Collins's masterpiece, The Simple Path to Wealth, your roadmap to financial independence and a rich, free life. If you've ever felt overwhelmed by complex investing jargon, or if you're tired of financial gurus promising magic formulas, this book is your antidote. Collins breaks down the intimidating world of finance into a handful of incredibly simple yet profoundly effective principles. It's a roadmap originally written as a series of letters to his teenage daughter, making it accessible, brutally honest, and deeply practical. This book isn't just about accumulating money. It's about buying the most valuable commodity on earth, freedom. The freedom to work when you want, where you want, and with whom you want. The freedom to walk away from a bad boss or a job you hate. The freedom to simply live life on your own terms. Over the next 3 parts, we'll unpack the core lessons of this book, covering everything from the toxic nature of debt to the power of low-cost index funds, and finally, how to safely spend your wealth once you achieve financial independence. But before we embark on this journey, if you find value in these insights, please do us a huge favor. Like this video, share it with a friend who needs to hear this message, and most importantly, subscribe to Bookmint for more mind-changing summaries. Your support helps us keep minting new ideas. Now, let's unlock the simple path to wealth.
Chapter 1. Beginnings and the Parable of the Monk and the Minister. Collins begins with a clear, uncompromising message. Money is the most powerful tool we have for navigating the complex world we've created. If you master it, it becomes a wonderful servant. If you don't, it will surely master you. The book's very existence stems from a series of letters written to his daughter, aimed at demystifying finance, which he felt was deliberately made complex by the financial industry to confuse people and profit from them. The core philosophy is encapsulated in the famous parable of the monk and the minister. 2 childhood friends meet later in life. One is a humble, shabbily dressed monk living on a simple diet of rice and beans. The other is a portly, wealthy minister to the king. The minister pities the monk, saying, "If you would learn to serve the king, you wouldn't have to live on rice and beans." The monk replies, "If you would learn to live on rice and beans, you wouldn't have to serve the king." This parable sets the tone for the entire book. Wealth is not about luxury, it is about freedom. The minister is rich, but enslaved by his need to maintain a lavish lifestyle. The monk is poor in possessions, but rich in freedom. Collins teaches that true financial independence is every bit as much about limiting needs as it is about how much money you have. It's about consciously choosing a simpler life now to buy your freedom later. The ultimate formula is introduced right here. Spend less than you earn, invest the surplus, avoid debt. Chapter 2. Orientation and the Unacceptable Burden of Debt. This chapter delivers one of the book's most critical and absolute lessons. Debt is a crisis that needs immediate attention and should be avoided at all costs. Collins calls debt, especially high-interest consumer debt, a vicious, pernicious destroyer of wealth-building potential. It is a financial ball and chain that enslaves you to your employer. When you carry debt, you are forced to go to a job you might hate simply to make the monthly payments. Your time, your most precious, non-renewable asset, is being spent to enrich the lender. The interest you pay is money stolen from your future self. Collins is particularly scathing about credit card debt, calling it pure evil. It's not a convenience, it's a trap. If you are currently in debt, regardless of any other financial goal, paying it off must be your primary task. It is the highest return on investment you can get, as the interest you save is a guaranteed, risk-free gain. The only acceptable forms of debt, according to Collins, are a well-managed mortgage and perhaps student loans, but only if they are for a degree with genuine earning potential,
and even these should be paid off as aggressively as possible. Every dollar spent on interest is a dollar that cannot compound for your future freedom. The simple path to wealth is impossible to walk while carrying the weight of debt. Chapter 3. Why you need FU money. This is where Collins introduces a concept that has since become legendary in the FIRE, Financial Independence, Retire Early community. FU money is not your retirement savings, although it certainly contributes to it. It is an immediate financial cushion, a pool of money, usually a year or more of living expenses, that gives you the ability to say FU to anyone or anything that tries to control your life. Hate your boss? FU money allows you to quit immediately and take the time you need to find a better job or even start your own. A major unexpected expense comes up. FU money ensures you don't have to break your investments or take on debt. The stock market crashes? FU money means you can ride out the downturn without panicking and selling at a loss. FU money is your first and most important step toward financial independence because it buys you immediate peace of mind and freedom of choice. Collins emphasizes that you should save your FU money in a safe, easily accessible place, like a high-yield savings account or very short-term treasury bills. This money is for defense, not for growth, and must be protected from market volatility. It's the ultimate security blanket that allows you to start investing in the market with confidence, knowing you have a shield against life's inevitable surprises.
Chapter 4. How to Think About Money. In this chapter, Collins shifts the focus from the mechanics of saving to the psychology of wealth. He argues that most people never learn how to think about money, viewing it only in terms of what it can buy right now: a new car, a bigger house, the latest gadget. He urges readers to change their perspective. Stop thinking about what your money can buy. Start thinking about what your money can earn. Every dollar you spend today is a dollar that cannot be invested to compound and grow for your future. This is the concept of opportunity cost, and it is profoundly important. That expensive coffee, that new car payment, that large house, they are not just dollars spent. They are hundreds, thousands, or even millions of dollars lost in future compound growth. Collins provides the stark example of a common scenario. A person who gets a raise immediately upgrades their lifestyle. A bigger car, a bigger house, more expensive tastes. This is the deadly trap of lifestyle inflation. No matter how high their income rises, their expenses rise with it, ensuring they remain financially enslaved, living paycheck to paycheck, even as a high-income earner. In contrast, the simple path encourages you to maintain or even lower your standard of living as your income increases, dramatically boosting your savings rate. The beauty of a high savings rate is twofold. You learn to live on less, making your ultimate goal of financial independence, FI, cheaper and easier to reach. And you have more surplus money to invest, accelerating the timeline to FI. This chapter is a call to be an observer of the world, noticing how debt and lifestyle inflation keep people trapped, and then consciously choosing the opposite path: simplicity, saving, and investing for freedom. Chapter 5. Can everyone really retire a millionaire? Collins addresses the common skepticism that his simple path is only for high-income earners. His answer is an emphatic yes. Almost anyone can achieve FI, although the timeline will vary based on two main factors: income and, more critically, the savings rate. He uses simple math to illustrate the relationship between savings rate and the time to reach FI. The magic number for FI, based on the reliable 4% rule, which we'll explore in detail later,
Is having a portfolio equal to 25 times your annual expenses? Savings rate versus time to financial independence. If you save 5% of your gross income, your time to FI is about 66 years. Saving 10% brings it down to 51 years. At 15% savings rate, you can reach FI in around 43 years. Increase that to 25% and it drops to just 32 years. Saving 50% cuts the journey dramatically to about 17 years. And if you can save 75%, you could reach financial independence in only 7 years. The higher your savings rate, the faster your freedom.
The table above is a wake-up call. It shows that the savings rate is far more powerful than the income level. A person earning $50,000 but saving 50% will reach FI much faster than a person earning $200,000 but only saving 10% due to an inflated lifestyle. The key takeaway is that you have control over one side of the equation immediately, your expenses. By radically reducing your expenses, you not only decrease the amount of money you need for FI, but you also increase the money available to invest, creating a powerful double whammy effect that dramatically cuts down the years to freedom. This chapter empowers the reader with the knowledge that freedom is not a privilege for the rich, it is an attainable goal for the disciplined. That concludes the first part of our deep dive into J.L. Collins's The Simple Path to Wealth. We've established the foundational mindset that wealth is freedom, that debt is an anchor, and that increasing your savings rate is the single most powerful lever you have. In Part 2, we will shift gears and explore the wealth-building engine itself. We'll delve into Collins's rock-solid case for index funds, why attempting to beat the market is a fool's errand, and how to navigate the inevitable market crashes without panicking. It's the core of his investment philosophy, simple, effective, and battle-tested. Remember, the path to a rich, free life begins with a single step. If you enjoyed this first segment, please hit the like button, share this with anyone who needs to hear it, and make sure you're subscribed to Bookmint so you don't miss Part 2. Part 2, The Wealth-Building Engine, the Market, and Index Funds. Bookmint Intro for Part 2. Welcome back to Bookmint. We are continuing our extensive summary of J.L. Collins's The Simple Path to Wealth. In Part 1, we learned that true wealth equals freedom. And the first steps on the path are to eliminate all debt and radically increase your savings rate to build your foundational FU money. We established that your biggest financial lever is not your income, but your spending habits. Now, in Part 2, we move from defense to offense. We're going to discuss the most powerful wealth-building tool in the world, the stock market. We will unlock Collins's simple yet devastatingly effective strategy for investing, a strategy that has allowed millions to achieve financial independence. If you've been putting off investing because it seems too complicated, prepare to have your mind changed. This is the chapter that will simplify your financial life forever. Before we dive in, a quick reminder. If you're enjoying this deep dive, please take a moment to like, share, and subscribe to Bookmint. Your engagement is the fuel that drives our work. Let's get into the wealth-building engine.
Chapter 6. Harnessing the World's Most Powerful Wealth-Building Tool. Collins makes a bold and evidence-based assertion. The stock market is the most effective wealth-building tool ever created. Over the long run, 10, 20, 30 years, the market has always trended up, always beating inflation and every other conventional asset class. The key is the phrase, over the long run. Collins acknowledges the fear that keeps most people out of the market, the crashes. He dedicates a substantial portion of this chapter to desensitizing the reader to market volatility. Market crashes are not a bug, they are a feature. They are inevitable. They are cyclical and they are normal. The market always recovers. History, going back over 100 years, proves this without exception. Every drop has been followed by a rise to new highs. A crash is actually a massive opportunity for the disciplined investor to buy assets at a discount. The greatest mistake most people make is trying to time the market, attempting to predict the top and the bottom. Collins emphatically states, you can't, and neither can anyone else. Even the most famous economists and financial gurus have terrible track records. By trying to time the market, people often miss the best performing days, which are crucial for long-term returns. The simple strategy is to get your money into the market as soon as possible and keep it there, consistently adding more regardless of what the market is doing. Chapter 7. Index funds are really just for lazy people, right? This is the heart of Collins's investment philosophy. Low-cost, broadly diversified stock index funds are the ultimate investment vehicle. Collins presents a clear, compelling argument against picking individual stocks and actively managed mutual funds. Complexity and time. Picking individual stocks requires immense research, time, and luck. You're trying to beat professional traders who have dedicated their entire lives to this, and even they often fail. The simple path frees your time and mind. Fees and taxes. Actively managed mutual funds charge high annual fees, often 1 to 2% or more. This seemingly small percentage absolutely devastates your long-term returns due to the power of compounding. Over 30 years, a 1% fee can cost you hundreds of thousands of dollars. Furthermore, active trading often results in higher tax bills due to frequent capital gains. Performance. The overwhelming evidence shows that 90% of actively managed funds fail to beat their benchmark index over the long run, especially after accounting for their high fees. You're paying a high price for underperformance. The solution: the Total Stock Market Index Fund. Collins champions the Vanguard Total Stock Market Index Fund, or its ETF counterpart, VTI. This single fund allows you to own a tiny piece of virtually every publicly traded company in the U.S. Lowest cost. The expense ratio, annual fee, is minuscule, often less than 0.04%. Maximum diversification. By owning the entire market, you're insulated from the failure of any single company. If one company goes bankrupt, your portfolio barely notices. Guaranteed to match the market. Since you own the market, you are guaranteed to get the market's average return over time. You may not beat the market, but you are almost guaranteed to beat the vast majority of professionals. Collins calls this strategy set it and forget it. It requires almost no financial expertise, no daily checking, and is the most reliable way to build wealth.
Chapter 8. Bonds and the 2 stages of investing. While the Total Stock Market Index Fund is the primary wealth builder, bonds play a crucial role, particularly as you get closer to, or are already in, the wealth preservation stage. Collins identifies 2 distinct stages of investing. The wealth accumulation stage. This is when you are working, saving, and actively adding new money to your investments. Your primary goal is maximum growth. During this stage, Collins recommends being 100% in stocks, VTSAX. Because you have a long time horizon, decades, you can afford to ride out the market crashes, and your consistent contributions will benefit from buying cheaper shares during a downturn. The wealth preservation stage. This begins when your earned income slows or stops and you begin drawing from your portfolio. Your primary goal is to protect your capital and ensure it lasts for your lifetime. The role of bonds. Bonds are essentially loans you make to a government, like the U.S. Treasury, or a corporation. They are lower risk than stocks, offer lower returns, and crucially, tend to go up when the stock market goes down. This makes them the ballast for your portfolio. In the preservation stage, Collins recommends a simple portfolio split, such as 75% stocks, VTSAX, 25% bonds, VBTLX, or maybe 60-40, depending on your risk tolerance. The bond portion is there to be sold during a stock market crash, so you don't have to sell your depressed stock shares. You sell bonds, which are stable or even up, and use that cash for living expenses, allowing your stock shares to recover. The mantra remains, keep it simple. One stock fund, one bond fund. That's all you need. Chapter 9. The Tax Buckets. 401k, IRA, Roth, HSA. This chapter navigates the often confusing landscape of tax-advantaged accounts in the U.S., which are critical for maximizing investment growth. Collins simplifies these accounts into buckets, each offering unique tax benefits. Note that these are U.S.-specific, but the underlying principle of maximizing tax-advantaged savings applies universally. The traditional bucket, 401k, traditional IRA, traditional TSP. Contributions are made pre-tax, lowering your taxable income today. Your money grows tax-deferred. You pay taxes on all withdrawals in retirement. Collins generally recommends this first, especially if your employer offers a match, which is free money. The Roth bucket, Roth IRA, Roth 401k. Contributions are made post-tax, but your money grows tax-free, and all withdrawals in retirement are completely tax-free. This is excellent for flexibility and a great hedge against potentially higher tax rates in the future. The HSA bucket, Health Savings Account. This is the triple tax-advantaged holy grail of investing. Contributions are tax-deductible, like a traditional account. It grows tax-deferred, and withdrawals for qualified medical expenses are tax-free, like a Roth account. If you don't use it for medical expenses, it acts like a traditional IRA in retirement. Maximize this bucket if you can. The rule of thumb. Contribute enough to your 401k to get the full employer match if applicable. Max out your HSA if you are eligible. Max out your Roth IRA or traditional IRA. Go back and max out your 401k. Invest any remaining surplus in a taxable brokerage account. The main takeaway is to always use the tax laws to your advantage. The money you save on taxes can be invested, leading to significantly faster wealth accumulation. Chapter 10. Magic Beans, and Why I Can't Pick Winning Stocks, and You Can't Either. In the Magic Beans section, Collins aggressively counters the siren call of get-rich-quick schemes, individual stock picking, and market timing. He recounts the story of Jack Bogle, the founder of Vanguard and the man credited with inventing the index fund, who was often ridiculed by the financial industry because his simple, low-cost product threatened their high-fee business model. Collins hammers home the point that the vast majority of people who attempt to pick winning stocks lose money or underperform the simple index fund. The illusion of skill. When a few individuals do beat the market, it is almost always due to luck, not skill, and they rarely repeat the performance consistently. Media hype. Financial news on TV, like CNBC, and in print, is not for your benefit. It is for generating ad revenue and trading commissions. It is designed to create confusion, fear, and excitement, leading you to trade, which only generates fees for the industry. The simple path requires you to ignore the noise. The costs of trading. Frequent buying and selling, trading, incurs commissions and high short-term capital gains taxes, which severely erode your gains. The message is clear and liberating. Sound investing is boring. The goal is not excitement or winning a financial game. The goal is to consistently and quietly buy the entire economy and let the power of compounding do the heavy lifting over decades.
The greatest enemy of the investor is not the market, but their own emotions, driven by fear and greed. The simple path removes the need for emotional decision-making. That brings us to the end of part 2 of our exploration of the simple path to wealth. We have laid the foundation for the wealth-building engine, the absolute power and simplicity of the total stock market index fund. We now know that our job is simple: fund our tax-advantaged accounts with VTSAX and leave it alone. In part 3, we'll complete the journey. We'll explore the final critical steps, understanding the end game, how to safely withdraw your money using the famous 4% rule, and how to handle the inevitable anxieties that come with both accumulation and preservation. If these concepts are changing the way you think about money, please show your support by clicking like, share this summary on your social media, and if you haven't already, subscribe to Book Mint for the final part of this series and much more.
Welcome back to Book Mint for the final and arguably most crucial part of our summary of J.L. Collins's The Simple Path to Wealth. In Part 1, we learned to manage our mindset and eliminate the corrosive influence of debt. In Part 2, we mastered the core investment strategy, using low-cost, total market index funds to harness the power of the stock market. Now, in Part 3, we address the ultimate question: what happens when you get there? How do you know when you have enough? And how do you responsibly and sustainably spend your wealth without running out of money? This is the chapter that truly unlocks the rich, free life. Understanding these final steps, the end game, is essential for the whole simple path to make sense. It's what you're investing for. Let's complete our journey to financial freedom. If you've gained clarity from this series, show your appreciation by hitting like, share, and subscribing to Book Mint right now. Chapter 11: Withdrawal Rates. How much can I spend anyway? The point of the entire process is to reach the moment your investment portfolio is large enough to fund your life forever. This moment is defined by the 4% rule. The 4% rule is based on extensive historical data and research, most famously the Trinity study. It suggests that if you withdraw 4% of your total portfolio's value in the first year of retirement and then adjust that withdrawal amount for inflation every subsequent year, you have a historical probability of success, meaning your money lasts for at least 30 years, of over 95%. The FI number, your roadmap to financial independence. To calculate your FI number, just take your desired annual expenses and multiply it by 25. Why 25? Because it's based on the 4% rule, and 1 divided by 0.04 equals 25. For example, if you want to spend $40,000 per year, your FI number becomes $40,000 times 25 equals $1 million. That means with $1 million invested, you could sustainably withdraw 4% each year and live on $40,000 without running out of money.
The philosophy of the 4% rule. The rule is designed to be conservative, protecting you from running out of money even through severe recessions and market crashes. Collins argues that the 4% rule is not just a withdrawal limit, it is the gate to your freedom. Once you hit your FI number, you are mathematically independent. He acknowledges that life is not static. In reality, you may need to be flexible, withdrawing less, maybe 3 to 3.5% during market crashes, and more during bull markets. But for the purpose of goal setting, the 4% rule is the best, simplest, and most reliable target. It transforms an intimidating, abstract goal into a concrete, measurable number. Chapter 12. How do I pull my 4%? The final anxiety for new retirees is often the question of how to take the money out of the portfolio without disrupting the long-term growth. Collins offers a simple, systematic approach that relies on the simple stock-bond split discussed in Part 2. The cash and bond buffer strategy. The goal: maintain a 1 to 5 year cash/bond buffer. This money is separated from the pure stock growth portion and is what you will use for living expenses, ensuring your stock funds have time to recover from a market drop. The strategy: the year in a nutshell. Normal market year. Bull or flat. You sell off some of your appreciating stock fund to fund your cash and bond buffer for the coming year. Down market year, bear market or crash. You do not sell any stocks. Instead, you use the cash and bonds you've already accumulated for your living expenses. This is the crucial step that prevents you from selling at a loss and turning a temporary drop into a permanent loss. The rebalancing. Once a year, you check your allocation. Example, 75% VTSAX, 25% bonds. If the market has gone way up and stocks now represent 80% of your portfolio, you sell the excess stock, the 5%, and use that money to buy more bonds/cash, bringing you back to 75-25. If the market has gone down, you do the reverse. Sell bonds, buy stocks. This is essentially buying low and selling high automatically, and it is the only market timing Collins recommends. This simple withdrawal strategy provides a massive psychological benefit. It keeps the preservation stage boring, predictable, and stress-free, which is exactly what a successful financial plan should be. Chapter 13. RMDs, the ugly surprise at the end of the tax-deferred rainbow. This is a specific but important tax consideration for those who have heavily used tax-deferred accounts like a traditional 401k or IRA. RMDs are rules set by the U.S. government that require you to start withdrawing a certain percentage of your tax-deferred accounts once you hit a certain age, currently 73, though this is subject to change. Since you never paid tax on the money going into these accounts, the government insists you begin withdrawing it and paying the tax on it at this age. The withdrawal percentage increases every year, and the penalty for noncompliance is extremely high. Collins' warning and solution. The danger is that these RMDs can be large, potentially pushing you into a higher tax bracket than you planned for in retirement. The solution is the Roth conversion ladder. In the years between leaving your job and the RMD age, Collins recommends slowly converting money from your traditional tax-deferred accounts into your Roth tax-free accounts each year. The goal is to convert an amount that keeps you in a low tax bracket now, so that by the time RMDs kick in, your traditional balance is smaller and a greater portion of your wealth is in the Roth bucket where withdrawals are tax-free and have no RMDs. This is an advanced strategy, but it is a critical piece of the endgame, ensuring you don't save diligently for decades only to be surprised by a large tax bill at the end.